The importance of self-confidence in investing. Number 0. What's more important than learning financial knowledge? Those reading this article with an interest in finoptio likely already have some interest in investing or are considering starting to invest. In that case, wouldn't it be efficient to dive right into specialized financial knowledge like valuation, quantitative investment methods, and the history of monetary systems to save time? Our perspective is different. Even among expert groups with substantial financial knowledge and finance-related careers, it's exceedingly rare to significantly grow personal wealth solely through investing. On the other hand, there are people who, without knowing anything about financial metrics like PER or PBR, accidentally follow the right investment principles and build substantial wealth. By investing over the long term, this suggests that there are other crucial factors contributing to investment success beyond financial knowledge. In this article, I'll explain why self-confidence in investing is the most important factor for successful investing. Number 1. Investing is a complex system. Its true nature reveals itself only over time. Why is confidence based on your own reasoning the most important factor for successful investing? Because investment results take much longer to materialize than most people expect. We are far more accustomed to immediate rewards than we realize. In school, studying brings the reward of test scores within at least a year. At work, completing tasks brings the reward of a paycheck within at least a month. However, investment results only start to show after at least 510 years. This is because school and work operate within a simple system, whereas investing is a complex system. To simplify for ease of explanation, in school and work, rewards are given 100% in the short term, based on the amount of studying or work put in. The structure is very straightforward with a simple cause and effect relationship. However, investing is different. Having extensive knowledge and putting in effort doesn't guarantee a 100% reward. In the short term, the cause and effect structure is highly complex. A key characteristic of such complex systems is that their true nature only reveals itself after long-term observation. It's easy to understand if you think of a baseball player. If you're given 2 options, which one would you choose? Option 1. A player with a .400 batting average will receive a prize if they achieve a batting average of .300 or higher in a single game tomorrow. Option 2. A player with a .400 batting average will receive a prize if they achieve a batting average of .300 or higher over the next 100 games. Of course, if the prize is the same, the second option has a much higher chance of success. The same goes for investing. Like a .400 hitter, finding an excellent investment strategy and sticking with it over the long term is essential to achieving investment returns, especially in investing where the cause-effect structure is far more complex than in baseball. It's essential to maintain the same investment strategy for at least 510 years. Without a clear reason for investing and a strong belief in your investment strategy, even a few failed investments can lead you to quit investing altogether. This means that no matter how good the investment strategy, stopping in the short term makes the likelihood of losses very high. This is a decision that fails to consider the characteristics of complex systems, where the true nature only reveals itself over the long term. That's why self-confidence is one of the most crucial factors in investing. Number 2. Can't I just leave investing to the experts? Even if you agree with the content so far, you might still have the following thought. Isn't it fine to just trust an expert and leave my money with them for the long term if I don't want to study? Just like I trust a doctor with my health since I don't have medical skills, shouldn't I leave investing to an expert if I don't have investment skills? As mentioned earlier, clients must stick to a solid investment strategy for the long term to achieve returns. In contrast, securities firms, one type of expert group, earn revenue from transaction fees only when clients trade frequently. Another expert group, asset management firms, earn revenue from management fees only when clients entrust a substantial amount of funds, especially for employees at securities and asset management firms, having strong performance in transaction fees and management fees. This year can lead to bonuses and a favorable position in salary negotiations. As a result, these expert groups are often more interested in generating high trading volumes or securing as much client capital as possible, rather than focusing on sticking to a solid strategy over the long term. Therefore, securities firms continuously recommend new stocks to buy, and asset management companies relentlessly launch funds based on the latest popular themes. Second, due to the characteristics of expert groups described earlier, Their long-term investment returns are often poor. You can easily see this by looking around. There are many people who became wealthy through real estate investments, business ventures, or direct investments. However, it's very difficult to find people who became wealthy by using a securities firm's PB center or by investing in funds. A securities firm's PB center is not a place to visit to become wealthy. It's where those who are already wealthy go to utilize services. Funds are a business that gathers small investors' money by promoting investments in popular themes, like robotics or AI, turning it into large-scale capital to collect management fees. It's not actually a business designed to make small investors wealthy. According to a survey by S&P Global, a U.S. financial services company, 90.08% of funds have recorded lower returns than the S&P 1500 index over the past 10 years. As of the end of the first half of 2024, as previously explained, investment is a complex system, and it generally takes 5 to 10 years of consistently following the same strategy for results to become apparent. However, given the nature of expert groups, where performance often needs to be demonstrated within a year, they tend to chase strategies that are only expected to perform well in the short term, even if they don't yield strong average results over the long term. This tendency ultimately leads to underperformance among expert groups. Therefore, entrusting investment decisions to expert groups may not be a wise choice. It's essential to remember that one should build confidence in their investments by developing their own rationale and convictions. Number 3, let's build a solid, personalized investment model through a scientific approach. How can one develop their own rationale and gain confidence in their investments? Let's examine the basis of various beliefs. What foundation should one rely on to maintain a consistent investment strategy? Over 5 to 10 years? How about relying on the authority of renowned investment experts as a basis for investment? In this case, even a slight loss in the investment process can lead to doubts about the authority of these experts, causing one to abandon the investment altogether. Or if that expert's authority diminishes for any reason, it's likely the investment will be abandoned as well. How about following the investment methods favored by people around you, the public or the media, relying on collective intelligence to guide your investments? The opinions of the group change constantly, and with them, my investments would keep shifting, leading to increasing losses. When everyone starts saying not to invest, my investments would likely come to a halt as well. Therefore, a scientific approach is essential to sustain investments over the long term. A scientific approach involves forming a hypothesis, testing it through experiments or statistics, and developing a model that can explain all possible phenomena. For example, young children naturally form hypotheses, constantly experimenting and observing to win their parents' affection. In the end, they develop a model like parental love equals eating well, plus being funny minus causing trouble. Then, they encounter situations that their existing model, built on brief experiments and observations, can't explain. This leaves them feeling very confused. They cheerfully try to charm their parents with a playful smile, yet their parents don't seem pleased. It was because it was 11 p.m., time to sleep. So, the child forms a new hypothesis like, why don't they like it? Do they only approve if I sleep at bedtime? And proceeds to test and observe this theory. The child then updates their model to parental love equals eating well plus being funny plus sleeping at bedtime minus causing trouble, allowing them to better interpret their parents' reactions and feel less confused. It's the same for investors. If they begin investing with a poorly constructed model, they'll encounter countless situations that their initial model can't explain. As confusion builds up, it naturally leads to giving up on investing altogether. Therefore, to continue investing without feeling overwhelmed by unexpected situations, it's essential to develop a solid model through a scientific approach. Investment is a means to achieve the goal of wealth. I will continuously provide learning opportunities to form solid models by setting hypotheses, testing and verifying whether investment is indeed a suitable means for achieving the wealth I desire. Number 4, 6 important facts to remember about investing. The key points to remember from this article are as follows. Unlike school or work, where cause and effect structures are straightforward, investment operates within a highly complex system. A defining feature of complex systems is that they